Hi, and welcome to the Stefan Livera podcast, focused on Bitcoin and Austrian economics. Today, for episode 122, we are speaking again with PlanB. But first, let me introduce the sponsors. So firstly, Kraken, one of the world's longest-standing, highly regarded Bitcoin exchanges. They bring a high-quality platform with high trading volume, low fees, and no minimum or hidden fees. They have 24/7 support. They offer the best-in-class accounting, reconciliation, and reporting services. And recently, they just announced the Kraken Pro mobile app. So Kraken Pro delivers all the security and features you love about Kraken Exchange, but in a beautiful mobile-first design for advanced Bitcoin trading on the go. So you generate an API key from the Kraken website, and then you use that to interact with the app. So also, there's Kraken OTC Desk for the more private and personalized service for large block trades, 100k USD or more. Kraken also support margin trading up to 5x long and short, and there's also futures up to 50 times leverage to benefit from price swings or hedge your price risk. Go to kraken.com. This episode is also brought to you by Unchained Capital. Unchained Capital is a Bitcoin financial services company empowering customers with unprecedented financial freedom and control. All of their products and services are built on the foundation of multi-sig, and their approach to collaborative custody gives users control over their private keys, as well as the benefit of a financial partner and financial services. So Unchained have 2 or 3 vaults. They're a great option for those thinking about how to best secure their Bitcoin for the long term. And if you ever need to access liquidity but without selling your Bitcoin, Unchained's collateralized loans offer a unique option. All the Bitcoin is stored on-chain in dedicated multi-sig addresses. It's never rehypothecated, and you can share in the security of your Bitcoin by holding one of 3 keys. I'm really impressed with Unchained. They're offering excellent services and releasing valuable content and open source tools. So learn more and sign up at unchained-capital.com. Next, check out givebitcoin.io. It's the easiest and safest way to get your friends and family into Bitcoin. Take it from me. I've given Bitcoin to people before and they lost it because they just simply didn't know what they were receiving. That's why I saw huge value in Give Bitcoin, which allows you to time lock your Bitcoin gift for 1 to 5 years. Every month for the first year, Give Bitcoin delivers a lesson of their world-class curriculum, put together with input from many well-known Bitcoiners, including Safedine, Matt Odell, Jan Pritzker, and others. I'm also an advisor with a small equity stake, assisting with the curriculum. You can also get Bitcoin as a present for birthdays, Christmas, bar mitzvahs, graduation, and weddings. So put Bitcoin on your wish list at givebitcoin.io. I really think givebitcoin.io can have a positive impact on Bitcoin adoption and understanding, so I'm excited to have them as a sponsor. Last but not least, Bitcoin Outlet. Bitcoin Outlet delivers rare and extraordinary merchandise to warriors of Bitcoin. Outstanding design is not blindly slapping your logo on any object available. At Bitcoin Outlet, every product they carry is a work of art with a thoughtful design. In keeping with the ethos of Bitcoin, all products created at Bitcoin Outlet are limited edition. Once a product sells out, that's all, folks. When you purchase something from Bitcoin Outlet, you'll be one of the only people in the world who have it. Bitcoin Outlet is a sister company to Canada's Bull Bitcoin, so both companies are Bitcoin maximalists through and through. Bitcoin Outlet only supports Bitcoin. This core belief has led them to align with other unapologetically maximalist companies. So if you want to rock some merch from a designer with some actual moral compass and unwavering maximalist views, head to bitcoinoutlet.com and grab yourself some of the best damn apparel on the planet. Use coupon code Livera for 21% off anything in store. So today the interview is with PlanB. His first 2 interviews were on my show, episodes 67 and 86. He is a pseudonymous Bitcoin Quant whose work has really been blowing up lately. And so there were some responses to his modeling work, and I thought it would be good to have him back to talk through some of the responses and his thoughts on them. So in this interview, we talk about cointegration. What is it? Why is it important? And importantly, we also talk about what's the Steelman case against his model. And then we also talk about what he's working on these days and what's next for him. I'm sure you'll enjoy this interview. Here it is. PlanB, welcome back for the 3rd episode.
Thanks for having me back.
There's been a lot happening since the first 2 episodes with you, PlanB. There's been a big blow up in your following, and you've had many more translations in your articles. How's that been for you?
It has been great. Again, I'm still waiting for the moment that all this stops or levels off, but I guess it's not now yet. So indeed, lots more people read the articles. I think the translations help enormously with that. For example, the Chinese translation was fun because I never knew that people in China cannot read Medium articles because it's fenced off by the firewall. So everything has to be on WeChat. But since that article is on WeChat, I guess it opened the article and the content to lots more people. Same with India. I never knew there were 6 languages in India, and well, there's only one translation translated in. I don't even remember what the exact language was, but 60 million people living there that can now read the article. So yeah, it has been phenomenal, and well, I hope it goes on for a little while.
Yeah, that's awesome. So let's just set some quick context. So listeners, check out the first 2 episodes. They are 67 and 86. But suppose we can just give some high-level context around the idea. So what you're essentially doing is some quantitative modeling on this relationship that has existed between the stock to flow ratio of Bitcoin and the price of Bitcoin. And I suppose just like, well, let's call out some of the high level numbers that you are in some sense predicting, or at least the model is predicting, let's say. So there are a couple of different numbers, and I believe you've got the 2020 halving, so approximately May 2020. Now, it doesn't mean it'll hit exactly that number then, but roughly. You've got 55,000 for then. I think it's roughly 400,000 for the 2024 halving, and then 3 million for 2028. Is that a fair summary, you would say?
Yeah, that's correct, and that's the numbers that were in the original article that I wrote in March this year. And maybe to go one step back, so I came to Bitcoin from a investor perspective. I am a traditional investor working at a large listed investment company in the Netherlands. So yeah, I approach this market not from a technical point of view, but from a purely investment point of view. And I noticed the lack of quantitative models, econometric models, if you will. There was a lot of technical analysis. But yeah, the model that I made is actually quite simple, trying to capture the price with a measure of scarcity. And I found the stock to flow measure quite useful. The stock to flow measure that is mentioned by Trace Mayer, but also by Seminal, of course, in his book. And the model I made is a linear regression on the logarithmic values of both price and stock to flow. And then you come up with a very nice fit, a high R squared. But what's even more important is the co-integration. We might talk later on that. But you're right. So the model predicts or models the last 10 years historical values of Bitcoin stock to flow and Bitcoin price. And because of the tight fit and the co-integration, well, it's at least reasonable to believe that it will hold for 1 or 2 more halvings. And the numbers you mentioned are absolutely correct.
Right. One clarification on that point. So I have seen some different numbers, and it might be just good to clarify for the listeners. For example, for the next halving for May 2020, approximately, I've seen a 55,000 number, and I've also seen a 100,000 number. Could you just clarify for the listeners where those 2 different numbers are coming from? As I understand, one of them is sort of only feeding the model the first few years of data. Is that correct?
Yeah, that's correct. And there's some confusion about it. So I'm glad to explain it. So the 55,000 number for next halving in May 2020, that was the number from the original model in the original March 2019 article. And that number was quite high in my opinion. I thought, well, we're now at the time of the writing, it was $3,000 or $4,000. So 55,000 seemed like a very high number, and I didn't want people to get over optimistic about it. So I rounded the parameters a little bit. So if you read the article, you see the formula is with nice round numbers, 0.4 times stock to flow to the power 3. And so 0.4 and 3 are the round numbers. But if you if you would take more digits, or you would get a little higher number. But then, of course, it becomes less easy to explain and to communicate. So the model evolved from March this year until where it's now. And of course, more data was added. The data of the first 55,000 model was until December 2018. And now, of course, we have 9 more months to take into account. Also, I have more earlier numbers, so data archaeology, where I do have numbers from September 2009 right now. So if we take that into account, just the new numbers, you get to values somewhere between 60 and 90,000. And those are also the numbers that all the other teams that replicated my model come up with. So there's one more model, and that's where the 100,000 comes from. That's the third model. And I personally prefer that one. I like it not because it's a higher number, but because that model was made on only pre-November 2012 data. So before there was any halving, on only the first 4 years of Bitcoin data. And yeah, that model predicted basically the 10x jump in price of 2012 halving and the 10x jump in price from the 2016 halving. So I'm really I'm really fond of out of sample performance. So I'd rather take a model that's done on less data but performs very well out of samples, so on new data, than taking all the data and fitting it as good as possible. So those are the 3 models: 55, 60 to 90,000, and 100,000.
Fantastic. Thank you for that clarification. Also, it might be interesting and valuable to talk about the timing. So typically what we have seen looking historically is the first halving was roughly mid-2012, and then 2013 was where we saw the big bull runs happen. And then the next one was in mid-2016, and then again we saw the bull runs happen in 2017, or one big bull run, let's call it. So would you say then that if you were to copy-paste that same pattern, the halving next time around will be mid-2020, but actually the run up will come in 2021? Would you say that's a fair statement, or what's your view there?
Yeah, I think that's a fair statement, but formally the model does not say anything about it. So there's no short-term prediction. There's no prediction of the all-time high or the next peak. There's also no prediction of the low. The only thing that you can take from the model is that you have the cointegration, and it will stick very close to the stock to flow level, and so somewhere before, say, Christmas 2021, the price should be above 100,000 if we take that third last model, or above 55,000 if you take the original model. So that's in fact the only thing that you can take from the model. And where the next halving is, or where the next all-time high is, sorry, it's guessing. But the way you said it is correct. Normally, or at least last 2 halvings, the market didn't react immediately on a halving, but it lagged a little bit. You could even model that lag, but I wanted to keep the model simple. So that's
fantastic. So let's jump into a little bit around some of the responses to your model, and then one of those is around cointegration as well. So as I understand, there's a gentleman named Fraudster, and I think his name is Nick. He wrote an article attempting to basically saying something like falsifying the stock to flow model. Could you help us break that down a little bit? Just give us an overview on that.
He's, by the way, he's an Australian guy.
Oh, really? I should talk to him.
Yeah, he'd like that. So Nick Frauda, indeed, he did a very important study on the model, and he's an interesting guy because he's saying he's very strict in learning and the academic approach. So he's saying like the only way you can learn is by falsifying things. You cannot verify things. You can only falsify things. So it's true until you falsify it, and that's why he called his research falsifying the stock to flow model, because that was his intention and his aim. So he went after it and basically did the same exercise I did. Came with the same conclusions, but then also raised the same question I did. Like, okay, you can have a very high R squared, especially in a logarithmic domain, but it could be spurious. It could be a false regression. It could be a correlation, not causation, a meaningless correlation that we measure. So he took one step more, and that's crucially important. He checked for co-integration, and co-integration is that two variables, stock to flow and price in this case, stick together. So the difference, so he's actually checking and testing and modeling the difference between the two. And if that difference stays stationary, that's a statistical term, but if it stays around zero and doesn't wander off too far, all is good. And the two series are co-integrated, which is very rare. So basically, if you find that two series are co-integrated, like he did, that means that the relationship that you find, the high correlation that you find, are not spurious. So that's why he concluded that he could not falsify the stock to flow model. So in that way, the title is a little bit misleading, but it was a very important moment also for me in the development of this model.
Great. Let's break that down a little bit. So from fraudster Nick's article, he mentioned a few different, if you will, assumptions that must be true before you can do this technique. He mentions the use of log scale. And so he's commenting that, and as you mentioned, it's log of stock to flow ratio and the log of BTC price. Can you articulate why that is?
Yeah, you need a linear relationship if you do a linear regression fit. So obviously, if you look at the stock to flow, but also price is even more important. If you look at the price of Bitcoin on a normal linear scale, it goes exponentially up, and you don't see any details before 2017 if you plot it that way. So to get more detail and to get more meaning, you have to transform the data to massage it into a linear line. So that's a massage might sound as manipulate, but it's just a transformation. So you transform the data. You try to see if a logarithmic regression is useful, or an exponential function is more useful, or if it can be transformed in a linear shape. And if you do that with stock to flow and the price, then you get this beautiful linear shape that you can fit with a linear regression. So basically what that means is that the regression that you fit on those data can be transformed in a power law. So that's the function I use. So that's the 0.4 times stock to flow to the power 3. That's a power law. And that basically, and that has also to do with the logarithmic scale, that models change. So not so much the level, but the change of stock to flow and the change of price. They are proportional. So for example, if the stock to flow goes 2x, the price goes 10x. And that's what the function says, the power law function. And that is true on a very small scale, So if it goes 3x or 0.3x, it doesn't matter. This power law stays the same, and that's the power of this logarithmic transformation.
Excellent, thank you for that. And there were some other terms that were used in order to, as he says, falsify the stock-to-flow model. He mentions the terms normality in error. Can you articulate what that is?
Yeah, the errors, those are the difference between the predicted values and the actual values, and the study of the analysis of how those errors look is very important, because there's all sorts of assumptions that are made about it. So they cannot be autocorrelated, for example. And they should be normal. So if you have the ideal model, what's left, so what's not explained by the model, should be white noise, as we call it. So that's normally distributed random noise. All the other factors out there impacting the price, but on average, leveling out to zero. And if you find normal errors, normally distributed errors around zero, then you know you have a good model. That's
great.
Basically.
And now, one way I've heard this explained around, I guess, speaking to the broader idea of co-integration, is that it's like a rubber band effect, that as one moves further away from the other, so in this case, Bitcoin price moving further away from the model, then it sort of rubber bands back to the model. Is that one way to think of this?
Yeah, and Nick has this nice classic story about the drunk and his dog, and the drunk going out with his dog on a leash. The drunk wanders in a sort of random fashion, and the dog has to go with him because he's on a leash. But sometimes he will be on the right, sometimes he will be on the left, but he cannot go further than the leash and come closer. So you don't know where the dog and the drunk are going, but you do know that they stay together. that is it's a classical example, but it exactly states what co-integration is, and that is very useful from multiple perspectives, but investment being one, and in this case it's even more interesting, because we know, of course, that the stock to flow isn't wandering like a drunk. It's predetermined. So for prediction purposes, this is almost too good to be true. Yeah.
Right, yeah, and he mentions at the end of the article, he's saying, in short, Bitcoin is the drunk and stock to flow is the road home.
Yeah, that's it. And you should have him on your podcast, because he can explain this a lot better than I do.
Oh, fantastic. Yeah, I might have to do that. Let's talk about some of the other responses to your work. So I believe there was Burger Crypto AM, who also did some similar sort of work. What was your take on his work?
Yeah, so Burger, Nick, and I sort of worked together. So we came into this separately, but our work was so related, and so now we're working with three of us together. Burger actually took the same path as Nick. He was very skeptical of the good fit and the high R squared. So he wrote an article, he verified the model, came with the same results, but really focused on the spurious, the possibility that it could be a spurious regression, which of course is a good point. And later in his second piece, just after Nick wrote about co-integration, he verified that co-integration as well, and even did some extra studies. So you can check co-integration with several tests, several different tests. He did like 3 or 4, and came with the same conclusion. So we all three now have a shared conclusion that we stand by, where we all began with being very, very skeptical. And so I see a lot of people in that first stage right now, where all three of us began a couple of months ago.
Great. And one other one I think might be interesting for you to touch on, and this is more like a very outside of the the ordinary least squares approach that you have taken, there was one by H.C. Berger 1, and it's basically a time-based model. Now, this one was a little interesting because he was basically predicting, based on this model, that the price would reach 100,000 per Bitcoin no earlier than 2021 and no later than 2028. So in some ways, it was a more conservative estimate. Have you had a chance to look at this modeling work, and do you have any comments on that?
Yes, it's an interesting study as well, and we talked too. The time models are classic. So instead of stock to flow, you take a look at time as an explanatory variable for the price of Bitcoin, and the narrative then it's like adoption that takes a time to play out, and that's what you see in the price, which is very reasonable. And in fact, it's where I began modeling as well before March this year. So the very first models I made were the exact same models as H.C. Berger did with the time, and we have the same parameters as well. So it's definitely it's an interesting model. The only thing is, first there's a big difference in predictions between stock to flow model and this time-based model. Like you said, the time-based models are lower in prediction. So it's very interesting to see, maybe not this halving, but especially after 2024 halving, the models really deviate from each other. So we'll see which one is right. Very exciting. But more importantly now is that what I don't like about the time model, and why I personally abandoned the model and jumped to stock to flow, is two things. First, the parameters are not stable. So the first time model is actually made in 2014. It's a classical chart. I have it somewhere in my. I will tweet it out later. It's a green price line with a red curve, the logarithmic curve in it, and I think it was updated later by To the Meester. So
yes, this is a well-known one. Tua shared it, I think.
Yeah, you shared it as well, I think. And what you see there is the prediction that was made in 2014, and it was much higher than the actual price that we see right now. So the red prediction line is way above the green real price in the updated chart by Tua. And then if you look at the model that was fitted on all the data, so including the data from 2014 till today, that H.E. Berger is using, then you see a much lower model. So the model came down significantly. And of course, now it really fits well. But my prediction would be that it will have to be updated again after 2024 halving. And so the stability of the parameters is a key thing for me, because I don't want to update the model every year, because I'd like to use it for prediction and investing. And like I said, the model that I prefer, the third incarnation of the stock to flow model, if you will, is made only on 2012 data before there was any halving, and it's still working today. So without any change on parameters. So that's, for me, is a crucial thing.
Yeah, that is a really fascinating thing, and it speaks to whether there is some kind of, again, it's not praxeology, it's not economic law, but potentially in an Austrian term, you might say something like timology, which relates more to like human psychology in response to markets, let's say, or psychological aspects that lead to human action. And as you were saying, this is before even there was a halving. Now, I think it would be good to talk about one critique that I have seen, where some people are laying a critique against the stock to flow model idea by saying, well, look, the stock to flow model, it explains the price only by reference to supply and not by demand. What's your thought on that?
Yeah, I get that critique a lot, and I understand it, because if you have an economic background, you are taught with the theory that prices are made on markets by buyers and sellers, and there has to be supply and demand, and where they meet, that's where the price is. So a model only on supply is weird in that sense. And that's true. I mean, I understand that critique. But the thing is, and Nick Szabo talked about it in the tweet this week as well.
The Veblen good idea, right?
Exactly. So it could very well be that Bitcoin is a Veblen good, and a Veblen good is a diamonds or Rolex watches would be an example. It's a good that where demand increases, where price increases, and that's 180 degrees different than demand and supply laws normally work, and that you are taught at school. Because normally, if prices rise, demand will drop and not rise. But there is some indication that Bitcoin is behaving like a Veblen good, and that would explain. So in that way, the demand is directly caused by the supply or the stock to flow, if you will. But even more important than that, so that might be the case. But even more important than that, and it's a general point, demand is not in the model, but lots of other factors are also not in the model that are important for the price. So, for example, if we look at the past 10 years, when China did this banning, China bans this, China bans that, yeah, it has an effect on price. Price goes down. China bans are not in my model. So when the government, the SEC or the CFTC or whatever, cracks down on Bitcoin or puts a FUD article in the media, it has an effect on price. Is it in my model? No, it's not in my model. So there's like tens of variables that are really important but that are not in my model, and still that doesn't mean the model is wrong or the model is not useful, because it's just a model. It's a model, and it's really a simple model. And I don't know who the quote is from, but the saying is, all models are wrong, but some are useful. And and I think that's true. I mean, if we look at the power law, and that's why I think it's interesting to have a non-spurious power law here. There's Bitcoin obviously is a complex system, very nonlinear, very dynamic, with at least 7 network effects, miners, investors, merchants, developers, all and regulators and countries. Everything has an impact on price. So to model that would be impossible. And in complex systems, what you see is sometimes there is an underlying structure that is very simple. So there is a complex reality, but a simple underlying structure, and that is what a power law can grasp. So in a way, I think the stock to flow, I don't know how exactly, of course, but in a way, that's what I measure. The stock to flow captures all this underlying complexity and including demand for whatever reason.
Right. And maybe another way to frame that might be something like, there are many factors, but it's just that stock to flow happens to be the dominant one right now. And that is not to say that it will always be the dominant one, as you mentioned. Maybe the model breaks down after 2028.
Yeah, exactly. Yeah, and there's one more thing: the demand, because if something has a high stock to flow ratio, there's not much things that have a high stock to flow ratio. Gold has it, Bitcoin has it, diamonds have it. Basically, it could be a definition of money, right? People use high stock to flow things for the function of money, and the demand for money, of course, is unlimited. There's always demand for money. So you could assume that to be there. It's a very, very rough assumption, but you could assume in a money model, which my model is, that demand is there, or at least that it's captured through the stock to flow.
Another point that I think I've seen you make is this idea that, and it's, I guess, harkening back to Nick Szabo with unforgeable costliness, but as you were mentioning, you were saying it's all about energy, and ultimately it's how much energy does it cost you to make Bitcoin versus any substitutes, right? So even in the case of gold and platinum and palladium and so on, there are some elements of substitutability amongst those other metals, but fundamentally it's about how much energy does it cost you to make them.
Yes, and there's some other critics that also go in this direction. I think it's Stephen Haber, or I forgot his name, but so he's also very much into pricing Bitcoin in watts, and it's a very interesting concept, which I think is correct. As you said, like gold is scarce because it's very expensive to mine it, and the same with Bitcoin, same with diamonds. And we can also see the opposite of that, right? If money is very easy to make, um, like our current fiat money, then it goes wrong. And we saw that in Zimbabwe very clearly, and more recently in Venezuela. You can just print the money as a government and spend it, but in the end, that will not last long, and it will not end well. And of course, this is, well, actually the reason why I came to Bitcoin, the whole quantitative easing experiment that is done by central banks today. Nobody knows how that will end. And some fear it will not end well. Me being one of those people, of course.
Of course, I think so. One other big critique that might be good to address at this point is the why is it not priced in idea. Now, one suggestion could be that most or everyone who knows about it is already invested as much as they reasonably can. But what's your view there?
Yeah, if I were to give a Steelman argument against the model, and I'm constantly looking for good arguments against the model because that's how I learn and that's how I know I'm investing the correct way. If I were to give a Steelman argument, it would be this argument. If the relationship is true, and if the information is out there as it is since March, or even earlier about the halvings should be priced in a reasonably efficient market. So this would be my ultimate argument against the model, and it's the one thing I do not understand why it is not priced into. It's not priced in the halvings, and it was also Nick Szabo's ultimate argument against the stock to flow model in his tweet last week. So yeah, why that is, I don't know, but I can guess, and I learned something this week about this. So for my first reaction would be, okay, markets are not efficient. Bitcoin is small with its 150 billion market cap. It's small, so maybe it's not efficient. But on the other hand, if you look at currencies and Bitcoin, it's very efficient. So you cannot buy Bitcoins with dollars and then convert it, sell them in euros, and then sell the euros for dollars and then make a profit or something. That could be done in the early days, but now you have exactly the foreign exchange rates on those Bitcoin prices. So markets are pretty efficient. I don't think that's the thing. The other thing would be, okay, the information is not out there for everybody. For example, new investors won't know immediately about the stock to flow model, so they don't know about it and they don't price it in. And maybe some of the current investors don't know yet about the model, although the model spreads like wildfire. So I think most of the investors right now know. But then the other argument, and that's the simplest argument, and I think that's the true one, is that there's lots of people that do not believe in the model, in the stock to flow relationship. So I put a tweet out yesterday with 3 well-known Bitcoin people that are against the stock to flow model with good arguments as well. I don't think they hold, but there are good arguments that you can follow and believe, and then you would be against the stock to flow model and not invest into a stock to flow price relationship. And in that view, the halvings would be less important than what I think they will be. So I guess it's just a normal market situation where there's not much people that really believe in the model, which is very interesting and a nice investment opportunity.
Yeah, that's well, for everyone who is a believer, I guess that's their opportunity. Let's turn now. One interesting topic that you were discussing was also this concept of downward difficulty adjustments, or stated in other words, Bitcoin bull markets seem to start at difficulty bottoms. So what's your take there?
Yeah. So what I learned from my career in investing, and so I'm a traditional investor. We do mortgages and bonds, and those are billions of dollars. So big deals. What I learned there, that it's very interesting to look at what the big buyers and sellers are doing. So the people that move billions of dollars have very good research, have very smart teams, great access to low prices. They have it all, and they are at the top of the spear, if you will. So looking at what they are doing might give you an edge just by following them. And the same is true with Bitcoin, in my opinion. Miners are the ones that are really invested in Bitcoin, because they invested in hardware, and mining these days is really only profitable if you are a professional industrial miner. So you need access to very cheap electricity, below 5, 4, 3 cents, almost free electricity. So you need to be next to a water dam or something else that where there's excess energy. Otherwise, you cannot make Bitcoins profitably. And you need the latest of the latest hardware. So the 7 nanometer chips, specific chips. Yeah, so the miners are big players, and of course they are big sellers. So they make Bitcoins, and once they make them, they have to sell at least part to make good for the electricity costs and the capital expenditure on the miners. So it is interesting to see what the miners are doing. And in bull markets, you see, and I'm not talking causation here, but just an observation. You see the hash rate and the difficulty go up. So and that means that miners are being added. Mining hardware is being added to the network, or the latest chips are being bought by miners and are increasing the hash rate and thereby the security, by the way, of the network. But so miners are investing, and the opposite is true in down markets. So in the latest bear market, and you saw that in last 2 bear markets as well, the 2 bear markets before this one, you see at a certain point that miners are switching off their old equipment because the price of Bitcoin is too low, and their miners are not profitable anymore. So it costs them more electricity than it gives them in revenue, and that's why they switch them off. And you can measure that, so you can see a drop in difficulty, and it's very rare. It only happened a couple of times in the last 10 years, and if you look at the lowest point of that difficulty decline, I call that the difficulty bottom, and mark that point from where it starts going up again. So miners are getting positive and investing again. That point in time has been the start of bull markets in the last three times. So it's very interesting to look at the big guys. It's by no means a statistical 100% verified and secure thing like the stock to flow model, but it's just I find it a very interesting observation.
Excellent. And just for the listeners, the prior difficulty downward adjustments, as you point out, they were late 2011, early 2015, and most recently, December 2018. So just for context for the listeners there. Turning now to your mission of trying to merge the worlds of Bitcoin and professional money management. Now, some of your work online, you've shown things like the Nassim Taleb influenced barbell portfolio of holding, say, 1 to 5% of Bitcoin and then the rest in cash, and showing that this has a much better return versus risk profile and obviously a much higher Sharpe ratio than the traditional 60/40 stocks and bonds or other traditional investments. Have you had any luck convincing professional money managers on that point?
Yes, I think I have. And you might have noticed indeed that I'm shifting my focus a little bit towards investors and investor podcasts as well, like the investor podcast with Preston Fish, or the interview I did with Real Vision and Raoul Paul lately, the gold versus Bitcoin thing. So I'm focusing on investors because that's also my background. And they are very, very skeptical. At least they were last year, the year before that, and maybe a couple of months ago. But something is starting to change. And you see the very forward-looking guys, the hedge funds, and let's say the group that Raoul Paul with Real Vision is targeting. That group is getting it. If you listen to Raoul, he's also saying that most of the people, or almost all the people that he knows, the CEOs of these and the CIOs of these hedge funds, are already invested in Bitcoin personally. So that's where it all starts, I think. So you see it there. You see also Anthony Pompliano, of course, with his company. Getting customers in the more traditional domains, the pension funds and the endowments. So that's a step. And you also see, if you look at the stock to flow model, which was discussed on CNBC the other day, you see a real turn in thinking there, which is remarkable. And the other day you had this German Landesbank, the Bayern Landesbank, who verified the stock to flow model and actually published the results to their clients. So you can see traditional parties that used to just tell all the mainstream media FUD, Bitcoin is for criminals, Bitcoin is a fraud, Bitcoin boils the oceans. You're seeing that turn slowly but surely. And I can give one example of my own company where I work, where nobody, except the quants, of course, that do the work, but nobody of the investors really wanted to know anything about Bitcoin. But the example that's really well received is the following. The Bitcoin futures markets are very interesting at the moment. If you look at the price of futures at the CME in Chicago or the ICE bucked system in New York, physically settled, you see that the future market is in contango. That means that the future prices, the prices next month and over 2 months and even over 3 to 6 months, are higher than the spot prices, so the current prices. And that opens the door to a classical carry trade construction. It's not complex. I'll explain it. It's like you have a Bitcoin position. You do buy Bitcoin and have a Bitcoin position, and then you sell that same position for delivery over 1 month or 2 months or 6 months. So you buy it and you immediately sell it against this higher future price. So you lock in a certain profit, a guaranteed profit. So in a way, that's a risk-free profit. If you there are some risks, but they are small. So you can do the same thing with gold: buy gold and future sell the gold, and then rinse and repeat every month. You would make 1% every year in return, which is low, but which is consistent with gold being very stable and risk-free. But if you do it with Bitcoin, like the way I described on CME or bucked, you can make like 12% per year, and that's almost risk-free. So if you pitch that example to a traditional money manager, his first reaction will be, that's not possible. And then when you show him the quotes, the actual quotes, he'll be like, okay, I have to know more about this. and, and that's the example I use nowadays for people with a traditional investing mindset. And that really gets them thinking and into Bitcoin. Actually, I know 3 guys who personally bought Bitcoin after this example, who are professional money managers.
So the proliferation of the carry trade idea, and I think we touched on this in some of our earlier episodes as well. One question I've got around that is the contango, as you mentioned, the future price being higher than the spot price. Part of that may just be driven by people having this future expectation of a rise in Bitcoin's price, so they're buying it. And is that part of what's driving that overall contango scenario?
Yes. There's 2 components. There's the actual cost component. So with gold, for example, you see the same thing. If you have physical gold, then you have to store it and you have to insure it. And that costs money. So that's why the future price of gold should be a little bit higher. Buyers of gold in the future will like the idea of not having to pay for storage and insurance next month or 2. So that real cost of storage and insurance explains part of it. The other part is speculation of what, like you say. So if there's lots of people that expect the price of Bitcoin to go to, well, let's say 55,000, then they can take on leverage, multiply their investing results by buying futures, and they will play the futures game. So yeah, in a way, and that of course, if they buy futures, that drives up the price of the futures and also creates contango. So in a way, it's the carry trade that I just describes is funded by the people that are very, very optimistic and are willing to carry that risk of Bitcoin. In a way, it's like the prelude to a option market, which I think Bucht is also introducing, which is very logical. So the people that think about 55,000 Bitcoin in 1 or 2 years, like me, if they're professional money managers, they think of it like an option. They think they have a certain probability that 55,000 scenario is happening. That probability might be low, might be like 10% or 20%. And the other scenario being it goes to 0, 80%. So that's sort of an option structure. But still, they would buy that future, and someone else is not willing to take that, even that 10 or 20% chance of a 55K scenario. So they rather have the cash and carry, where they make a certain, let's say 10% per year. And it's a great way of futures markets bringing together speculators and more risk-averse investors.
Excellent. Plan B, do you have any other related projects or other things that you're working on at the moment?
Yeah, there's lots of projects, and there's some I can mention maybe. So in the summer I was busy with all the translations of the article, which is great, and there's 24 now. But right now, lots of people are replicating the models and building real-time versions of models on websites. There's Digitalic, a Swiss guy who made a very nice website, and we're sort of working together. And I'm thinking of not making my own charts anymore. I'm just using his charts because they are evolved in even better charts than I can make, and they're real time. So that's very nice. You might also have seen the art thing that I'm involved in. The charts that I make inspire me, but also some of my followers. So they want high resolution prints and stuff. So and that's great. I have that same desire, and so I decided to take it one step further and commission an artist that is, by the way, one of my followers, and approached me on Twitter. So we met face to face, and she is now making an artwork of one of the charts. And I think that's important, because Bitcoin is more than just numbers and investments. It's a movement, and it's very important that it's not only programmers and investors are involved, but also the art world. So science has to meet art, and yeah, it's something I'm really excited about. The other thing you might have seen that is pure science is chain analysis. So we talked about minor capitulation and difficulty drops and that kind of stuff. You can extract a lot more data from the blockchain than only difficulty or stock to flow ratio. You can, you have 300 gigabytes of data that you can analyze and extract, and I'm diving into that with new computers, new ideas, and with a more high frequency trading point of view. And the things that you find are actually very interesting. I have not tweeted or written about it. I'm sure that will come, and that absorbs a lot of my attention at the moment. But it's very interesting what information you can get from the chain.
That's awesome. It sounds great. I'm really looking forward to hearing about what you've got coming up next. I suppose just as a final comment for the listeners, can you just let them know what should they be watching and thinking about just to understand if the model has broken down, or is there anything else? Are there any other people who you would like to hear from?
The model it's very simple. So if the co-integration is gone, if it doesn't show in the next 1 or 2 years, if it's gone, then the model breaks down. And so my point, it's a bit conservative. I'd like to see it earlier than that, but if Bitcoin is not above 100,000 or the 50,000, depending on the model you'd like to use, if it's not above that numbers before Christmas 2021, then the model is in real trouble. And probably so am I, because I made it. But it is a possibility, of course. Let me finish with that. It's just a model. It's not a guarantee for quick profits, and it can be wrong. So please watch that. And in the meantime, there's lots of things going on around the world. So especially also in the investor world, that slowly but surely starts to understand Bitcoin and starts to invest in Bitcoin. And I expect a lot more investors piling in. And the halving around May 2020 might, of course, help with that. If prices do indeed rise like they did last 2 times and like is predicted by my model, that would create the setting where at least the investors that believe in Bitcoin and want to pitch it to their investment committees, at least those people will have better charts to show there and have a somewhat better story than they have now, because now you could still argue that Bitcoin is dead and it will never go to the all-time high of 20,000 again. But once that point is reached, I think we'll see an exponential rise in interest of investors.
Fantastic. So Plan B, just let the listeners know where they can find you and follow you as well.
Yeah, so I'm on Twitter at 100 trillion US dollars, 100 with a 100 and then trillion USD. And my article is on Medium. It's called Modeling Bitcoin's Value with Scarcity. But most of the time you can find me on Twitter, and all the DMs are open. So please reach out. I like it, and I still can manage to answer at least all the DMs. So yeah.
Well, thank you very much. It's been a fascinating conversation.
Thank you, Stefan.
If you want the show notes or the transcript, go to stefanlivera.com. There's also a link to subscribe to the show there. If you want to support the show, share it with your family and friends or in your chat groups, and email me if you've got any feedback or if you want to sponsor the show, stefanlivera@pm.me. Thanks for listening, and I will see you in the Citadels.